This is the Michael Bryan Show. Hi everyone, welcome back to the show, and today I'm joined with Dan Passarelli, who is a trader, an author, and a world-renowned trading expert. So we are talking day trading, investing, and some best practices. Dan, thanks so much for taking the time today.
Hey, Michael, it is really great to be here.
So I'm really curious about how investing has shifted for you since you started. Is there anything that's happened from when you started investing to today?
Oh my goodness. Yeah, a gazillion things. I don't even know where to begin.
There's a lot that people are unaware of. So what would you say were some of the things that maybe that are less talked about in terms of investing?
The biggest and most obvious thing are options. When I started in the professional trading industry and investing for me and my family's account, options were sort of an alternative product, is how a lot of people would phrase it. But since then, they've become totally mainstream. And it seems like everybody I talk to, at least has heard about options these days, which wasn't the thing, 20 some years ago. That massive transformation and growth within the options industry has just been one great example.
How would you describe what options were then? For someone that isn't quite sure what you mean by that, what are they?
They're a financial tool that helps traders and investors manage the risk of owning a stock. And you can use them in lots and lots of different ways. You can use them to reduce risk, basically buy insurance on a stock or even an entire portfolio. You can use them for the opposite reason, to increase leverage and be able to make more when the market goes your way while risking more if the market goes against you. And then you can use them to even sort of tweak that standard risk reward profile, if you will, and be able to get somewhat more reward with only marginally more risk. Or you could just make money if the market goes sideways or is volatile. They're a really versatile tool. And I mean, if you want, I can kind of break down the building blocks of it real quick.
I think so, only because lots of people would struggle to get involved in investing because of the risk that could come with that.
When it comes to investing with stocks, everything that anyone knows is still valid when using options. But there are two types of options. There are call options, and a call option is when the person who owns that call has the right to buy the underlying stock at a specific price called the strike price between now and its expiration date. These options are contracts, literally between two parties. So one person owns that call, they own that right to buy the stock, and they bought that contract from someone else who is short that contract. They have the obligation to deliver the stock to the owner if the owner decides to exercise that right. And then the other one is the put option. Someone who owns a put option contract owns the right to sell a stock at a specific price called the strike price on or before the expiration date. What's important there is a lot of people use that as really an insurance policy. If I own the right to sell the stock at a certain price, if it goes down below that price, I'm protected. But it works the same way with puts. It is a contract between two people. The party that owns the put, who owns the right to sell the stock, bought it from someone who sold it short to that person, who has the obligation then to buy the stock from that person if they decide to exercise their right to sell it.
It makes me think, Dan, of the idea of blockchain when that was a big talking point as well, because that usually is like a contract between two people or two digital IDs essentially, and it's protected and everyone knows where it came from and where it's gone to, so it's a lot more transparent than what it used to be. Is that what we're thinking of when it comes to these options? Are we along the same sort of lines?
Yeah, Michael, it's funny. I never thought about it in that regard. But yeah, I think you could draw an analogy there. When options started, there was a whole lot of paperwork involved. They were always protected, and they started back in early 70s. They were always protected and still are protected by what we call the Options Clearing Corporation, OCC. And they're basically a party that guarantees those rights, because if someone guarantees the right to sell a stock to somebody and the other person has to buy the stock, they're obligated to buy the stock, the put seller, for in this example. What if the put seller doesn't have that money? Well, that's where the OCC comes in, guarantee all the trades. Yeah, that used to be traders down on the trading floor writing up tickets on pieces of paper with a ballpoint pen and turning it into a clerk who went to the key punch and they type that in, and stack of papers goes to the OCC. And oh my gosh, it was so labor intensive. I mean, now it's a lot more electronic. They haven't technically exactly started using a blockchain in this process, to the best of my knowledge. But yeah, it sure is pretty streamlined, and that whole guarantee thing all happens in the background. Trades are processed within milliseconds. Me sitting at my computer, doing my research, deciding what to invest in, what sort of options to overlay that strategy with. I click a button, it goes to the broker, goes to the exchange, goes back to the broker, back to me in like a second. So it is pretty amazing how the technology is advanced along with this.
From a 30,000 foot view, it makes people think of some kind of avenue towards building wealth, at least trying to invest, and it might even pay dividends over the long term. Is that still the case? Do you think there's a real argument for whether it's the average person or someone with the income that they could put towards this, that they could actually build some considerable wealth with using this method as well?
Oh, yeah, yeah. I mean, there are studies that prove you can outperform the markets while lowering your risk in terms of standard deviation. This is by now a pretty proven, tried and true recipe for sure. Yes.
So how would someone with no real trading knowledge get involved? If someone wanted to take the first few steps, let's say 5 steps or so, how would someone go about it?
Like anything else, the more you learn, the more you earn. That's definitely not investing, even not using options. Investing is not really something to just jump into headfirst brashly, like, oh, yeah, I know what I'm doing. It's really, really important to get that knowledge. And, your last question about, paraphrasing a little bit, just about how things have changed and, is it like it used to be and such. There's this kind of tongue-in-cheek joke of a statement, I guess, that you hear tossed around in the investing world pretty often, and that is, it's different this time, because fundamentals of how stocks work, which I mean, that's the underlying for options anyway, the fundamentals for how a stock works mechanically in terms of, do dividends matter, and how does that all work? How should I think about the value of a stock? That hasn't changed in well over 100 years. I mean, Benjamin Graham wrote some of his, well, he wrote a couple of books back in what, the 19 teens, and they are still valid today. So it's never really different this time. When people start saying it's different this time, the jig is up. There's something coming down the pipeline, because people are thinking about this tried and true standard thing, that kind of almost in a way simple knowledge that's been the same for over a century, probably a lot longer. People are treating it like it's different this time, but it never really is.
That's an interesting point as well, because when you think of smoke and mirrors, but maybe that's not the right way of phrasing it, where people are thinking that there's more to it. People are thinking like there's this magic concept or magic bit of information that can change everything for them. But in reality, it's been the same for a long time. You just need to know where to go to understand it.
Yeah, I mean, I would say that is definitely exactly it. And, you should never invest in anything if you don't understand it. Some people just really don't care about how corporations work and economics and how business works. And that's fine. There's a million things that you could devote your interest to, and it sure doesn't have to be these things that I like, economics and finance and corporate things. I just find them interesting. I like to figure out how they tick. If that's not you, whoever it is I'm talking to, that's okay. You can hire somebody to do this for you. Obviously, there's a fee for it, but hopefully you find a decent professional who can give you value for what you're paying for. But if it is something you're interested in, I think you kind of really have to embrace it. I think for you to be good at anything, you have to be interested in it. When you are interested and you do your research on just how to value a stock and then dig into a company and start learning more about that company, when you understand it, it can be a great opportunity to invest in it. But when you don't, and we were talking a little bit before you turned on the record button, Michael, about just some of these nouveau quote unquote investments, that are not stocks or options or bonds or whatever, like NFTs, for example. I remember a few years ago when those were popular, and I just remember sitting there scratching my head like, I don't really get it. It's a picture and there can never be one exactly like it, but who really cares? And people are like, oh no, you just don't get it. I was like, yeah, you're right. I don't get it.
This is the thing as well, because people will talk about things that are valuable to them or things that they're interested in, and yet there needs to be some way of measuring the value of it, whether it's a company, whether it's a picture, whether it's, I don't know, baseball cards, Pokemon cards, whatever the case is, there must be some way of measuring the value of it for there to be a value of it. Like, surely if you invest in something, hopefully it goes up in value. So how do we determine that? How do we know that this will go up if, as you said, people don't care about NFTs anymore? And well, why would they ever go up then? Like, how do we determine that? How do we know that it's worthwhile?
Yeah, yeah, that's a really good point. And I think that there are always two things involved with any investment. There's the tangible, logical side of it, and then there's the psychology side of it. With a stock, for example, when you buy shares of a company, you literally own shares of a company. You own parts of that company. If the company is driving revenue and that revenue is either steady or growing, then the company is literally making money for you. And that share of the profit literally is yours. But the shareholders have elected officers, CEO, and that kind of thing, to manage the company and make financial decisions on their behalf because, a million people can't manage a company. You need point of accountability. And so with a corporation, they'll either pay you dividends, and that's what you're buying. You're buying the future dividend stream, you're buying an income stream, or they'll choose not to pay dividends and they'll choose to reinvest that capital into the company on your behalf, which grows the company so they can grow more revenue. And that's very tangible. That's very logical. It's very easy to see. And you don't see that with things like Pokemon cards or NFTs or that kind of thing. That's 100% psychology. In the future, will someone feel that this thing that doesn't generate any income be worth more? That's always a hard question to answer. I mean, that's a tough one.
Suppose in some ways there'd need to be something that goes up in value. I mean, there must be a way of trying to make these decisions then, because it sounds like there'd be people out there unsure of investing because of these things that have happened. Or, when you think, well, if you're taking information or taking history and thinking, right, that's going to inform my decisions today, NFTs disappearing, people investing in things that go up, they go down, they disappear overnight, people are less likely to want to do it. People are less likely to want to get involved in something that might disappear in a month or two. So how do you make your personal investing decisions?
If it is some sort of asset that doesn't have some sort of proven income stream, it becomes more difficult to evaluate. Now, that being said, There are some assets that I do currently invest in that don't necessarily have a future income stream. Things like commodities, whether we're talking about futures or the actual physical commodities. Last year, gold kicked the pants off of the S&P 500. I mean, they outperformed the living heck out of it. There's a lot of differing views on this, but I believe that there were some very good reasons for that. If you track how much the central banks, specifically like Poland, China, Uzbekistan, and a couple of other, India, they have been buying gold month after month after month, every month of last year in pretty big quantities, in quantities that outpace the amount of gold that's mined. The rest is just made up from recycling it. Long story short, I mean, there's proven demand there, like proven demand, and that word is the important thing. When we're talking about a novelty item, how do you prove that that demand is there? Well, I mean, I don't know. I don't think there's a way, and that's why I personally am a little bit more, well, no, I'm a lot more cautious about it. I tend to not invest in those kind of things where I can't either see an income stream or physically see proof of value, demand going up or supply tightening.
Do you find then that it's a bit more concrete in terms of making decisions then because you can't really rely on psychology and yet something that generates an income, if that goes up, then it's an obvious sign that the value of it will go up as well, in that you're better off investing in something that generates an income or generates some kind of value for people to justify the investment or justify the cost of it. You know, when you mentioned that the stock could be valued at X amount, surely that comes from somewhere.
I mean, with corporations, they are required, well, at least in the US, corporations are required to publicly announce their earnings on a quarterly basis. And along with that, they publish the quarterly financial statements right around the same time. And people can look, they get to look at the books. They get to say, oh, okay, so profit here has increased. So this company that I could own, well, they're increasing the amount of money that I could be making if I owned a share of that. Um, and I think that people tend to overcomplicate this issue. I mean, don't get me wrong. Like I said, the more you learn, the more you earn. There's always somebody who's going to know more and be smarter than the next person. But I think from the just most basic level, people overcomplicate it. If I were to sell you like a promise to pay you $10 a month for the next year, so 120 bucks, and it was guaranteed, how much would you pay me to have that income stream? Well, it would be something, whatever makes sense to you. But then if there was somebody else next to me, or if I changed my mind and said, well, instead of giving you $10 a month, I'm going to give you $20 a month, you could afford to pay more. You'd be quite okay paying more for that because you're getting more from that. And that's really just how corporations or bonds or real estate, that's kind of how any investment works.
So where would someone like you go for this information? You mentioned that companies can release their accounts essentially or their finances so they become public record. But how about researching companies or researching something that you're thinking of investing in? Where do you go for that research? Do you have any go-to places? Is there anything that maybe the general population might not be aware of?
Yeah, so I mean, geez, there's a lot of resources. I'll definitely look at the charts and that kind of thing on a trading platform. But also, I mean, the earnings are really, really important. You can go to a company's investor relations website, and all you do is you Google the stock symbol, AAPL investor relations, type enter, and go to the events page and find out when their next earnings is. They usually announce it, a couple weeks beforehand. Wait for the number to come out, and there's always a conference call that comes along with it. If you want to put in the time, listen to the conference call. That's where you get a lot of the great information, or read up on the companies. And well, I'll tell you what, it's become a really great tool for this too is AI, is using ChatGPT or Claude or whatever your poison is. You can get excellent mileage out of just asking a chatbot, tell me about this company. What is their price to earnings ratio? What are the tailwinds? What are the headwinds? What has their earnings been increasing or decreasing? There's lots of things you can do.
I'd be really curious to work out some of these questions that you mentioned there, because it sounds like you'll get better answers if you learn to ask better questions. Does it just come from experience, do you think, Dan? Or do you think there are some ways that the people listening could potentially ask these kinds of questions as well? Because I'm picturing the better questions you ask, the better answers you get, and then the more information you can find out as well.
Yeah, I mean, that's the thing about AI is it can replace some of the tasks of people, and people fear that it'll replace their job one day, and maybe with some jobs it will replace them, or at least big parts of them. It's not a substitute for thinking. It's a tool to enable you to think better and get information faster, but not a substitute for thinking. So before even thinking about using ChatGPT to get information about a company, you got to learn what information is important. Because I'm in options education, the one thing that I know from teaching people about trading and investing is that everybody learns different. It's just kind of how you're wired. Some people like reading books. Some people like watching videos. Some people like getting in live classes or video classes. Some people like chat rooms. And I do a number of those things with market taker mentoring, where I do a lot of our work. And I just wrote my third book on investing with options as opposed to trading. So kind of like right in the sweet spot of what we're talking about. But, I also do videos and such for people who learn better that way.
What kind of things drew you to writing the books then? Was it a need that you saw in the market? What drew you to start writing?
Back many years, I mean, I wrote my first book in 2010, which was pretty well received. It's consistently rated in the top five options books out there. I was working actually for the exchange at this time, and I had a mentor. His name was Jim Bittman, who kind of taught me how to teach, if you will. And he had written a few books. And one day I was just chatting with him. I was like, oh, hey, maybe I should write a book. He goes, oh, yeah, that's a good idea. And, long story short, next thing you know, I'm talking to, well, back then it was Bloomberg, who was subsequently purchased by Wiley. They said, well, what's your topic going to be? And I was like, well, at the time, I didn't even think of that. I just thought it'd be fun to write a book. And I came to realize that there was nothing at the time written on what we call the option Greeks. And the option Greeks are a set of metrics to help investors make better decisions using options. And so, after looking around on Amazon or whatever, I was like, how's it possible that there's not been a book written on this? Like, this is the most important set of tools for people who use options in their investing. There's no information out there on it. So that ended up being my first book. And then, just being on the front lines and talking to lots and lots of traders and investors every year, whether in person or in online classes or webinars. I get to see the blind spots, if you will. I get to see where investors are needing some guidance or some knowledge, and that really drives, what I write about in books or what I write about on my Substack or do on my podcast.
Do you find then that it's like a new platform altogether, or could people pick any investing platform and go down this road?
They say use the right tool for the right job, right? True in carpentry, true in trading. I mean, there are some people who are maybe older and need a fixed income and they do nothing but invest in bonds and dividend paying stocks. Well, you don't need a super fancy trading platform for that. You just want one with low commissions, then that'll give you information on bonds and dividends. For investors who use options, you will need a platform where, first of all, you can get options information and they deliver the tools for you, the option Greeks, like we talked about, options volatility charts, and a couple other things that are important for analyzing options positions. It's really, really important to have the tools that you need to use the strategy that you're trying to use. Because without the right tools, I mean, a lot of people focus on commissions and things, and those are definitely very important, but they don't really mean anything if you can't make decent decisions because you don't have the right tools.
Do you find then that people get the tools wrong? Let's say they want to invest in stocks or bonds, but they pick something that can make that difficult?
Yeah, I mean, well, it's like we were talking about NFTs. Like, how do I know that this is going to go up? I mean, there's literally no information that I have. There's nothing aggregated that shares what public demand is. And we know the supply is only one, but still, it doesn't matter. If I don't know the demand, it doesn't matter. So, yeah, I mean, if I'm looking at dividend paying stocks and bonds, if I can't get the dividend history of that stock, and I'll have to also look at their earnings because if their earnings are, falling or going negative, they can't continue paying dividends. Um, if I can't get that information, the platform's useless to me. But I mean, the good news is once you have the education, you read the books, you attend the webinars, you do the classes, then you know what tools you need. Then it's just a matter of going and finding them because there's seemingly like 100 platforms out there and they all do somewhat different things. I mean, there's definitely a lot of overlap, but there are some that specialize in very, very specific things. I'm in the process of building one out myself actually right now for what we call the wheel, which is investing with covered calls and cash secured puts options in conservative long-term investing. And I'm building it just because that's the one thing I can't find the tools out there for. So I'm creating them for myself and then we'll probably make it available to, our students and such.
So, what would be your best bet if someone wanted to start investing? Where are they best off going to start with?
Yeah. So step one, get a book. If you're somebody who likes to read, you go to Amazon, you find one that's highly rated on something that you think you might find interesting. Now, you might get halfway through the book and be like, God, I don't find this interesting at all. And that's okay. Try again with another one until you find an aspect of investing that you do find interesting. And then sooner or later, you'll have read enough books or half of books where you've picked up a broader amount of information and then you can take that forward and start looking for a platform. And again, if you're not the kind of person who enjoys reading, there are, I mean, there's some great writers on Substack that I read, and I contribute to Substack as well. I write my own articles, but that's a great place to start. Podcasts. I listen to a lot of podcasts, but also have my own wealth building with options. Whatever the medium you enjoy. I mean, personally, for me, I'm pretty busy during the day trading, and so by the end of the day, sometimes I'm reading a book, and sometimes I'm just like, oh man, I'm gonna binge a show on Netflix or something. So personally, I love listening to podcasts because I can listen to them while I'm driving. I can listen to them while I'm exercising. It's just a good way to multitask and make the best use of your time. But, I mean, it's different for everybody.
And then if someone, let's say I wanted to invest in a stock or in something else, maybe even an option down as well, how would I go about it? What would be the steps to take?
Yeah, so here's one way to look at it, and I'll give you a pretty basic way to do this. And this is I'm just standing on the shoulders of giants, as they say. I'm just drawing from the experience of books that I read by people way smarter than me who came before me. But for a stock, what I like to do is I like to look at the price to earnings ratio, which is just the price of the stock divided by the earnings from the past 12 months, the last 4 quarters. And that gives me an idea of how much am I paying for this profit that I'm going to get, whether me getting it means the CEO decides to reinvest it in the company on my behalf or pay me a dividend. That's the answer to a different question. But how much am I willing to pay for these earnings that will be mine? So to me, that's one super important way to look at it. Another way is price to book ratio, which is basically to kind of just make it in really simple terms. It's okay, here's a company that owns a bunch of stuff. They've got a factory, they've got an office building, and proprietary intellectual property. Add up all their assets, subtract all their liabilities. That's another way to think of what the company's worth. How much am I willing to pay for my share of that? Still another way to look at it. And when I say another way, I don't mean a different way. I mean in conjunction with the other ones that I just mentioned, is price to free cash flow from operating. That's not necessarily their earnings, but it's the cash that they bring in from operations, meaning running the company, selling whatever product or services they sell. Because a company can bring in cash a number of different ways, like they can borrow money from the bank, they can issue more shares, they can sell off one of those factories. But that's not what we're interested in as an investor. We're interested in how much cash is this company bringing in from selling stuff. And so the price to that gives me still another ratio that helps me make better decisions. When we talk about these three ratios where the price is on top, so we just call them price on top ratios, the lower the better, because the lower the price to that cash flow or book value or earnings, the better. I want to pay as low a price as possible. And I mean, when it comes to the PE ratio, price earnings ratio, it depends on a number of factors, but I'm definitely looking for something closer to like, 12 or 10 or something like that. When it comes to book value, I'm usually looking for something under 2. When I'm comparing that against companies within the same industry, I want the lowest one. But I mean, there's one pretty simple method right there.
I find it interesting how easy it can be to actually get involved in this. It sounds like it's easier than ever to actually get started.
Oh gosh, man. Yeah. I mean, it's I remember about 5 years ago they used to throw around the word democratized like it was going out of style, but it's become completely democratized. I mean, geez, I remember from when I was a kid, commercials for brokers, E.F. Hutton and Brown Brothers and such. It used to be you would have to get on the phone, call your broker, send them in a check or wire it in, and it was a big production to even trade anything. I mean, now you download the platform, you wire the money in, 10 minutes later, well, realistically, probably 20 minutes later, you got to sign some electronic documents and, that kind of thing. But I mean, you're up and running in 20 minutes, you're trading. It's very, I mean, that's a very powerful tool. It's like a gun or a car or something like that. Like, you've got to respect this thing and not treat it frivolously. It is a very powerful tool, and you want to be very, very knowledgeable about it first.
I've learned a lot about this. It's thanks to people like yourself, Dan, where they're able to break it down and make it a bit more consumable, which I guess is one of the reasons why you wrote this book. I wonder if people wanted to grab the book, how could they? How can they go to connect with you?
Yes, so the book that I have coming out, it's called Build Consistent Wealth with Options, and it is due out April 28th. I spent a long time writing that book. It was a labor of love, certainly a labor. I put all my energy and every ounce of my being into it. It was a very important project to me. Mark your calendars, April 28th. It'll be available everywhere that books are sold.
And you mentioned the Substack as well, so is your chance to invite people to join that and possibly your social media as well.
My Substack is a similar name to it. It's Wealth Building with Options. So, yeah, I go into quite a bit of detail with those articles.
Thanks so much for being a guest on the show. Those that are listening, feel free to subscribe, share the show, tell others, and also leave a review wherever you are listening into your podcasts. Dan, this has been great. I've enjoyed it, and I look forward to keeping in touch. Thank you.
Thank you, Michael. I had fun myself.